Good afternoon and welcome to the quarterly State of the Market update. I'll be your host, Jeremy Wassmer. Today we're going to be looking at the events that are currently driving the markets, and we'll share our thoughts on what investors need to be aware of as we head into the second half of 2021. Now, before we get started, I'm going to let you get settled, have a time to go and grab a drink of water, go to the restroom. In the meantime, I'm going to put up our disclosure page, and we'll get started here in about 1 minute. All right, so we'll go ahead and get started. Thank you all for joining with me today. My name is Jeremy. I am the associate planner here at the Life Wealth Group, and today we'll be going through the State of the Market quarterly update. And some of the things that we'll be talking about today include inflation, interest rates, bond yields. We'll talk about the infrastructure package, the budget bill. We'll look at the second half of the year outlook. We'll talk about emerging European and global markets, and also investor sentiment. As I go through, if you have any questions, please type them into the chat box. I will likely get to those toward the end. If not, I'll follow up with you on those questions. So one of the things I'm going to share as well is a PDF that you can download. And that is just a quick summary of what we'll be talking about today. Also, if you have an interest in scheduling a time to meet with Hilgard or Shay, please do so, and Susan will be glad to assist you with that. All right, so I'm going to go ahead and get started. So quarter two, there was vaccine rollouts that happened throughout the second quarter, and the economy and markets continued to grow as the country slowly reopened. But can that momentum continue from the first and second quarter into the second half of 2021? So as vaccinations increased, the economy slowly reopened. Vaccines became widely available to all Americans in the second quarter. States that were hit hard by the virus, like California and New York, were finally able to reopen as more people received vaccinations. The economy started to come back online. This is kind of a blurry picture, but I'll try to explain. Starting in the top left-hand side of the graph is the year-over-year GDP growth in the U.S. And in the first quarter, the U.S. economic growth was strong at 6.4%, and GDP growth is now positive year-over-year. We've pretty much recovered by and large from where we were when we shut down the economy. In the short term, GDP is looking strong. However, some experts are calling for 10% GDP growth in quarter two, as the economy was starting to come back online. However, some experts believe that 10% GDP growth is a stretch for quarter two, and believe that the original euphoria and pent-up demand of opening the state economies may have driven the quarter one growth and may show tampering down in quarter two to below a 10% GDP expectation. On the top right-hand side, you can see the year-over-year industrial production and productivity graph. for U.S. labor productivity. And productivity, surprisingly, has increased year over year. There's something about not having to commute to work at the traditional office, and the conventional wisdom that productivity can only be achieved at the office has seemingly changed, perhaps for good. Companies and workers have realized that they can be productive away from the office, and many people may not return to the office in the foreseeable future. One of the major concerns has been inflation. Prices are starting to go up for our goods and services. Inflation has been a major concern, and Americans have been spending the money that they received as stimulus and the money that they saved during lockdowns. As a result, demand is up, but our supply chains are still struggling to regain full capacity. We're all paying more for everything from food and houses to gas and cars. One of the largest debates is whether inflation is transitory or non-transitory, meaning temporary, or if it's a part of a longer-term trend. One of the reasons why some experts believe that the current level of inflation is transitory or temporary is that they believe lagging supply may be currently be caused by a temporary bottleneck of supply. And assuming the economy continues to reopen, raw materials and component shortages are expected to improve, as well as supplier delivery times shortening, lessening price pressures. The measure of inflation is high as a percentage, but in absolute terms, it can be perceived as within a normal range. To be put into context, let's pretend that Jeremy and Hilgard are lifting weights. Jeremy is lifting 200 pounds of weights, and Hilgard is lifting 100 pounds of weights. Then we both decide to add 10 pounds to our weights. Jeremy is now lifting 210 pounds, and Hilgard is now lifting 110 pounds. We've moved up in absolute numbers on the weight, but on a percentage basis, Hilgard is now lifting more weight as a percentage of where he started. Since 10 pounds is a higher number as a percentage relative to 100 than it is to 200. So Hilgard seems to be lifting more weights as a percentage. The same thing is implied to what's happening with inflation today compared to last year, which was a dumpster fire. In 2019, the economy was great. And when you took inflation today, and when you look at inflation today in absolute terms, the inflation numbers are debatably in a normal level in the eyes of centralized banks. Let's look at lumber. There was a supply and demand unequilibrium with lumber. You had a massive demand for new homes and less supply. Once the supply shortages improve and suppliers are able to regain footing and demand slows down, then prices should start to normalize. As a long-term trend, however, it is entirely possible that inflation could be higher in the years ahead compared to the last economic cycle, spanning from 2009 to 2019. Inflation was historically low during this time, and the recent upsurge in pressures may indicate a return to historical norms. We're continuing to monitor this, and we see which side of the prevailing theories starts to pan out as to whether the current levels of inflation are transitory or not, and will remain a sharp focus. So on to unemployment. Weekly unemployment claims have finally started to come down in Q2. New weekly unemployment claims finally dropped significantly in the second quarter. This number will most likely continue to decline as federal unemployment benefits end over the summer and schools reopen, allowing people to return to work. However, with the recent surge in the Delta variant, some of that is back in doubt as to whether there's going to be lockdowns. So we're continuing to monitor that to see how that pans out. The unemployment rate fell from 13.3% in May 2020 to 5.8% in May 2021. However, we hit a record 9.3 million job openings in the second quarter. Business owners are reporting that they're having a hard time finding workers. Last summer, a year ago this time, some pundits in the media gave the impression that we were going to do a V-shaped recovery on job employment. That didn't turn out to be the case, and the path back to full employment has been a lot slower than some anticipated. Another thing we learned is that if the government pays people not to work, then they're not going to return to work. The biggest challenge owning a business right now is finding workers to fill the record number of new roles. As unemployment benefit programs end and schools reopen, which we're seeing that may be in doubt. We'll see how the Delta variant is controlled. We should see people returning back to work. However, depending on how pervasive the Delta variant becomes and the vaccination rates, that could slow the rate of people returning to the workforce if schools do not reopen and there's an increased fear of contracting the virus. All right, so I want to go through 3 of these economic indicators. So these are the leading economic indicators. First is the initial jobless claims, which we talked about, are moving in the right direction. There was a recent hiccup in the last week where there was an uptick of unemployment claims, but it's expected to continue to decline throughout the summer. It's not where we want to be relative to 2019, but the amount of available jobs isn't the problem. It's the amount of people we can get to fill those jobs. For manufacturing, for the US, the index that we want to look at is the non-manufacturing ISM index, because the US economy is mostly a service-based economy. Anything above 50% is growth oriented, and anything below 50% is bad. So under manufacturing, the non-manufacturing ISM index shows 60.1% in May, which indicates in Q2 that we were strongly in a growth stance. Housing, building permits were down, where we're seeing a sign of a slowdown, and it could be for various reasons. If you're graduating school right now, it's cost prohibitive to buy a house, reducing the amount of demand in the market. And as supply increases, prices may begin to normalize more, but we're moving in the right direction. So now we'll go on to equity markets. Markets continue to do their growth in Q1, and we hit multiple highs. The Dow, for example, reached 34,750 before dipping down just to under 34,000. The leading economic indicators show that in Q2, we were squarely in a growth stance. Consumers were strong and flush with stimulus cash and pent-up demand. When DC has stimulus spending packages flooding the system with $120 billion per month, whether it's good or bad, Wall Street has not seen a stimulus bill that they haven't liked, and some of the recently proposed spending bills are unprecedented in size, which, if implemented, would continue to drive markets forward for the remainder of 2021, which is good for equities in the short term. The Fed has indicated that they plan to keep interest rates where they are for now. They are going to telegraph to us exactly what's going to happen. They don't want to see volatility, and they're going to have to taper quantitative easing before they start raising rates, meaning they're going to go from $120 billion per month of quantitative easing to $100 billion to $80 billion over months and months. And then they'll start to talk about slowly raising rates. It remains to be seen whether this policy stance changes. So since March of 2020, we've seen a gradual reduction of volatility. So what we're looking for at the second half of 2021 is whether this volatility returns. We want to look out for negative reports on unemployment, inflation, or policy errors that could lead to an increase in volatility, and see if that trend continues or if it's going to reverse trend. So what do we want to watch in the second half of 2021? The outlook indicators for the second half of 2021, we'll start with GDP. It looks positive in the short term. Even though the second quarter was strong, job and inflation remained weak spots. Consumer demand was strong in quarter two, but began to wane toward the end. We want to continue to watch if consumer demand is sustainable in the second half of 2021 once the stimulus programs have stopped. We also want to see the unemployment rate to decrease and start moving toward fuller employment once continued enhanced benefits from the government has ended and record job openings start to be filled. The equity markets in Q2 largely shrugged off concerns of inflation. We want to closely monitor inflation throughout the second half of 2021 to see whether or not inflation is transitory or if it's here to stay for a long-term trend. But we're less worried and would not hit the panic button on inflation at this time. There are concerns that the recent increase in consumer demand may be unsustainable and will cause companies to ramp up production, pay higher wages, borrow more to make more, and if and when stimulus to the economy dries up, companies will have excess product and labor, resulting in liquidation and downsizing due to reduced demand and subsequent layoffs and slowdowns. The second indicator, the equities market, looks neutral in the short term. Ever since inflation talks have ramped up, the equities market outlook has become neutral going into the second half of 2021. The stock market in the first half of 2021 was very good, and we've posted new highs. However, if the major drivers of the economy begin to slow down, like quantitative easing from the Fed, abnormally low rates, and excessive government spending, then where does the next bump come from for the markets? Good advice for investors in the next quarter is to review your risk tolerance with your financial advisor or with us, and to ensure it lines up with your portfolio risk to ensure you have enough liquidity if you're taking income from your investments in retirement. Some investors may consider taking a more conservative stance if you're concerned about what's happening. The third indicator, volatility, looks to be negative in the short term. If the major drivers of the economy ends, then companies' earnings expectations may begin to wane over the course of the second half of the year. We also want to closely monitor the Fed's timing of increasing interest rates, as an increase may erode company earnings further. However, we believe that the Fed will increase rates slowly, while tapering down stimulus over the next year or two, which will help us to get to a natural equilibrium of sustainable growth. The fourth indicator, price to earnings, looks to be neutral in the second half of 2021. Coming to an agreement on the infrastructure bill, the family plan, and the $6 trillion spending budget are major factors in how the remainder of 2021 will play out. And if they don't come to pass, we could see a deceleration. Onward to the third quarter, the best course of action right now is to stay vigilant. Investors will be fine if they are positioned appropriately with an investment allocation based on your retirement distribution plan, which we do for our clients. One of the things that get in people's way with investing is letting politics drive their view of the market. It's best to leave your political allegiances to the side when making investment decisions, and letting your financial plan dictate the investment allocations as we do with our clients. All right, so on to the fun stuff. Shay Kate, she's a financial advisor in our office. She has some upcoming events here toward the end of the year. She'll do some weekly videos on financial topics, and she has a lunch and learn scheduled for December 10th for ladies who lunch and invest. And if you're interested, please give Susan in our office a call to book your time to be able to sit in on that. A couple of other upcoming events: August 3rd, 5th, and September 14th and 16th. There'll be a seminar at Chef's Table, and we'll talk about how to help lower and potentially eliminate taxes in retirement. September 17th, we'll do a lunch and learn. The topic will be family and finances, hosted by Hilgart, something that is near and dear to him. November 17th, Fire and Ice event. We'll be looking forward to seeing you there. And finally, if you know anybody who is concerned about their retirement or their investment portfolio, or would just like to meet Hilgart and Eunice, then we always have this offer for dinner at Bella Colina, where you can introduce or meet Hilgart and Eunice over dinner. Just want to go over briefly the Ambassador Club program. Ambassador Club inductees introduce us to at least one person that you know. You'll be invited to Ambassador Club gatherings. You'll have priority registration to client educational and social gatherings. And we'll have recognition for all client gatherings for those in the Ambassador Club. The Ambassador Elite Club is if you introduce 2 or more people that you know, and you'll have the elite exclusive gatherings. You'll do a $50 donation to your favorite charity, or we will. The priority registration for invitation only travel excursions. So you'll have priority on those. We have an upcoming Ambassador and Elite event on August 27th, which is dinner at Bull and Bear Restaurant at Waldorf Astoria. One of the things that Hilgart also does is he has a company called Life Wealth Transition Partners. If you or someone you know is thinking about selling their business, then Hilgart can help develop a strategy with a team of experts that helps to protect your family and your future. This is the Life Wealth Travel Concierge. If you haven't heard of it already, this is a concierge service that we have clients referred to that you can get a second opinion from Jeff Lavender, who kind of heads the Life Wealth Travel Concierge program, and he'll give you his expert opinion on your travel plans. This is also a cruise that will be occurring on October 7th through the 14th. This is called the Silver Sea Cruise from Rome to Venice. So we have clients signed up for that, and it's going to be a Mediterranean voyage. So this is going to happen. It's going to go to Italy, Greece, and Croatia. So that's October 7th through the 14th. One of the exciting things that's happening is that we're moving buildings. We are in a temporary location in Winter Garden, and we'll be moving to a new building that's being constructed in Winter Garden. And so we're looking forward to that later in the year, in October, November. So the last thing we want to do is encourage you to not worry if you are concerned about any of the topics we discussed today. Feel free to schedule a time with Hilgart or Shay, and we can go through your retirement plan and make sure that your portfolio risk is in line with your distributions. Very good. I appreciate all your time. I'll take questions and probably will respond to anybody. It looks like one of the questions was, are we in the new office already? The answer is no. We'll be moving here toward the end of October, beginning of November, once the construction is completed. We know that from last year, markets that were soaring had a sudden drop, which is a painful reminder that things can shift pretty quickly. So we encourage you with that backdrop. If that causes anxiety for you, then it's probably good time to look at your risk and adjust anything that's needed for your plan. As always, I'm here to answer any questions that you have, and looking forward to seeing you soon. Have a great day. Thank you for joining us.